It happens the moment your paycheck hits your account. Before you can even celebrate, it's gone. Rent, groceries, the gas pump, and subscription fees pull at your hard-earned money from every direction. It feels like you're running on a treadmill just to stay in the exact same place. To make matters worse, that treadmill is speeding up. Every year, the numbers on the price tags climb a little higher while your purchasing power drops. Inflation isn't just a textbook concept, it's a silent tax on your time, creating a constant, quiet pressure. At some point, the realization clicks. You cannot outwork inflation by trading your hours for dollars forever. You need to shift from working for money to building a system where your money works for you. You need an engine that generates wealth while you sleep. When you step into the world of investing, you'll quickly find two distinct tribes, each claiming to have the ultimate answer. On one side is Team Dividend, focused on consistent cash flow. On the other is Team Index Fund, focused on total market growth. It's a classic debate that goes beyond just math. Dividend investing feels incredibly rewarding because you see actual cash landing in your account. Index fund investing looks mathematically superior on paper, focusing on long-term compounding and capital gains. It's a battle between human emotion and pure logic. Because when the market inevitably takes a downturn, pure logic often flies out the window. Watching your portfolio value plummet in red percentages causes real emotional pain. Your brain treats a market crash like a physical threat, testing your resolve to its absolute limits. That is why the choice between dividends and index funds isn't just a spreadsheet math problem, it's a psychological game. The best mathematical strategy is completely useless if your emotions cause you to panic and sell at the absolute bottom. Investing is just as much about behavior as it is about finance. Let's look at Team Dividend first. Their philosophy is simple: buy a piece of a mature, stable business and get paid a share of their profits just for holding it. You aren't betting on a stock price chart going up, you're collecting regular, predictable payouts from real-world commerce. Many dividend investors focus on an elite group known as dividend aristocrats. These are massive blue-chip companies that have not only paid, but increased their dividend payouts every single year for at least 25 consecutive years. They've survived recessions, high inflation, and market crashes, offering a bedrock of stability. This creates a massive psychological advantage during a bear market. Even if the market crashes by 30%, those dividend checks keep arriving in your account. While other investors are panicking over fluctuating prices, dividend investors are calmly watching their cash flow remain intact. To a dividend investor, a drop in stock price is just a temporary paper loss. They view their portfolio like a rental property. If the market value of the house drops but the tenant keeps paying the same monthly rent, the asset is still doing its job perfectly. The wealth engine never stops running. While panic-stricken investors are constantly refreshing their apps, stressed about their shrinking net worth, the dividend investor is disconnected from the chaos. They measure success by the size of their cash flow, not the daily mood swings of the stock market. However, we must look at the reality. Dividends are not free money. When a company pays a dividend, that cash leaves its balance sheet and the stock price drops by the exact amount of the payout. It's a transfer of value from the company to you, not the creation of new wealth out of thin air. This brings us to a major danger: the yield trap. Beginners are often lured in by companies offering massive double-digit dividend yields, but a high yield is usually a warning sign that the company is struggling, the stock price has collapsed, and the dividend is about to be cut completely. This is why Team Index Fund takes a completely different path. Instead of trying to pick individual winning companies, they choose to buy the entire market. With a single index fund, you instantly own a tiny piece of hundreds or thousands of the world's largest, most successful corporations. Index investing offers ultimate diversification and low costs. You don't have to spend hours analyzing financial balance sheets or worrying if one single company goes bankrupt. If one business fails, it is automatically replaced in the index by a rising competitor. You simply ride the wave of global economic growth. And those low fees matter immensely over time. Just like wealth compounds, tiny management fees compound in reverse, quietly eating away at your future net worth. By keeping your costs close to zero, you ensure that the maximum amount of money stays in your portfolio, working entirely for you. History shows us that over a 15-year period, more than 85% of professional fund managers fail to beat a simple index fund. If the smartest minds on Wall Street with all their data and algorithms cannot consistently beat the broader market, the wisest move for retail investors is simply to own the market. But how do index investors live off their portfolio in retirement without dividends? Think of it like owning a massive orchard of fruit trees. Instead of waiting for a tree to drop a piece of fruit, you simply harvest and sell a small percentage of your trees when you need cash, leaving the rest of the orchard to grow. The real secret is consistency. Whether you choose dividends or index funds, the ultimate secret to building true wealth isn't your specific strategy, it is your consistency. Automating a recurring deposit every single week, month after month, beats trying to time the market perfectly every single time. Consistent habit always defeats temporary heroics. In the beginning, your progress will feel painfully slow. Your contributions do all the heavy lifting, but over years and decades, the snowball effect takes over. Your returns begin making returns, and the compounding growth completely eclipses the amount of money you originally put in. For dividend investors, this compounding engine runs on a beautiful closed loop. Your dividends are automatically used to buy more shares, which then produce even larger dividends next quarter, which then buy even more shares. It's a self-sustaining wealth machine that accelerates over time. At the end of the day, the portfolio that wins isn't the one with the highest mathematical return on a spreadsheet. It is the portfolio that you can stick with during a severe economic crisis. A less efficient strategy that keeps you calm and invested will always beat a perfect strategy that you abandon in a panic. To maximize your chosen strategy, you must be smart about taxes and account structures. Dividends paid in a regular taxable account are chipped away at by Uncle Sam every single year. Utilizing tax-advantaged accounts allows your wealth engine to compound completely unhindered by the drag of annual taxes. Before risking your hard-earned money, take the time to do the boring, necessary work. Read the fund fact sheet. Check the expense ratios, understand the underlying holdings, and know exactly what you are paying for. True wealth is built on careful, unglamorous attention to detail. So, what is the final verdict? If you want pure mathematical optimization, historical data favors the total market diversification of index funds. But if you know that seeing sharp drops in your portfolio value will cause you to panic sell, the consistent, reassuring cash flow of dividend investing is vastly superior for your behavior. You also don't have to choose just one side. Many successful investors build a hybrid strategy. They use broad market index funds to aggressively grow their wealth during their early working years and gradually shift into dependable dividend-paying assets as they approach retirement to secure steady income. The path you choose matters far less than your willingness to stay on it for decades. Wealth creation is a long, quiet walk across a timeline of years and cycles. Ignore the daily noise of the financial news, trust your long-term system, and let time do the heavy lifting for you. Now, I want to hear from you. Which investing philosophy aligns best with your personal psychology? Are you team dividend, team index fund, or are you building a hybrid strategy for your retirement? Let me know in the comments below. Don't worry about whether the market went up or down today. Instead, ask yourself the only question that truly matters for your future financial freedom. Did I invest this week? Keep it simple, stay consistent, and focus on the habit.
Enjoyed the video? Like, subscribe, comment, and share the investing mindset with others. Thanks.